Thank you to everyone on this call for joining me today for the year-end Global Flexible Fund update. The Global Flexible Fund gained 0.7% in the fourth quarter and 12.8% for the trailing 12 months, ahead of the fund's performance indicator and the World Value Index, but behind the MSCI World Index on a trailing one-year basis. Taking a longer-term view, we're pleased that the fund remains ahead of its performance indicator for each of the past 1, 3, and 5 years. And importantly, while it is subjective, we believe our results have been achieved without exposing shareholders to meaningful risk of long-term capital impairment. In the trailing 12 months, Global Flex's top 5 performers contributed 6.5% to its return, while the bottom 5 detracted 2.1%. Looking at the top 5 contributors, we like to think that the varied names are very much illustrative of our flexible strategy, in that we have 2 GARPy securities with Alphabet and Meta, complemented by 3 classical value-oriented investments in the form of Jefferies, Citigroup, and Wholesome. Perhaps the only common characteristic among the group is that each of the contributors have been held in the portfolio now for multiple years. Turning to the detractors, several long-term holdings were a drag on performance, including LG Corp, a Korean chaebol, Glencore, JD Peets, and Comcast, while Heineken Holdings is a more recent purchase, relatively speaking. Global Flexible's net exposure, equities and bonds, is down a little over 4 percentage points year over year and now sits slightly under 60%. The lower exposure is not so much driven by any top-down views we hold on how the market may perform over the coming 12 to 24 months, but rather as a result of security analysis on a bottoms-up basis. Not surprisingly, after strong years of back-to-back performance by the market as a whole, we've either trimmed or fully exited several names where our analysis concluded the prospective future returns merited reducing position sizing. The fund's asset allocation is illustrated on this slide, and what stands out at the moment is a significant cash position at approximately 40%, while the most prominent risk asset exposure continues to be the broad sector of communication services at 14%, where you'll find many of our largest holdings. As a percentage of equity, approximately 35% of Global Flexible's exposure is to companies based outside the United States. As we often point out, where a company is domiciled is of secondary importance to the quality of a business and the price at which it trades. More relevant, if we examine the revenue composition of our portfolio companies, approximately 52% is derived from outside the United States. Moving to the topic of valuations, looking at the United States versus the rest of the world, you can see from this slide the multiple dispersion has widened significantly of late, with the US currently trading at circa 22 times earnings, and the AQUI ex-US closer to 13 times. We're fortunate that our mandate allows us to invest broadly across the globe, which is particularly advantageous in a moment like the present. Along these lines, many of our purchases this year have been from outside the United States. Now that said, the gap between the US and international stocks is not quite so wide if you exclude the MAG 7 from the index, with the multiple for the US dropping to closer to 19 times, albeit this is still markedly higher than the 13 times multiple we saw for international stocks on the prior slide. However, across all markets, there are pockets where there are certain sectors trading at discounts to historical levels. Looking specifically at European consumer staples, you can see the multiple for the group is roughly 15.5 times earnings, which is not only a significant discount to US consumer staples, but is also about as cheap as a sector has been valued at any point over the past 5 years, with the exclusion of a 1-week period during the 2020 pandemic. With that in mind, perhaps not surprisingly, we are leaning into sector weakness to add to our exposure in the space, which includes JD Peets, Pernod Ricard, and Heineken Holdings. Moreover, on our estimate, each of these names trades at a discount to the 15 PE multiple of the Euro consumer staples sector, and that is despite what we believe to be growth prospects of a comparable basis to staples overall. That concludes the prepared remarks of the presentation, and I'll now answer some pre-submitted questions. The first question, Can you tell us any other areas you're spending your time? Well, within both the US and abroad, we have been dipping our toes in the water on mid-cap stocks. None of the names are likely to be top 10 positions individually due to liquidity, but as a group, we think they will definitely have a chance to move the needle for performance over the coming years. In addition, several of these names can be found outside the US. Hence, we believe they're trading at compelling discounts to that of broader indices. Second question, yields have increased, though we haven't seen your credit exposure increase materially. Why is that? Well, despite rates on high yield having moved higher alongside rising rates, the actual spread on high yield compared to treasuries or investment grade credit is bouncing along historical lows. When we combine this with the relatively weak credit protection attached to recent high yield issuance in the form of non-existent or paper-thin covenants, our bar to get involved in high yield in general would require a rate of return north of what's currently available. The next question picks up on our largest detractors, and it says, you noted you continue to maintain exposure to consumer staples which have performed poorly. Can you please walk us through an investment thesis behind one of your holdings? As noted when I discussed the slide of detractors, I mentioned that Heineken Holdings was one of our more recent purchases. This is the holding company of Heineken, the beer I would expect you all to have heard of. Now, we like the beer industry overall, and in the past we've actually owned both Carlsberg and AB InBev. Now, we think the industry is neat as it combines the personality of a consumer staple with the economies of scale that come with manufacturing and logistics. Other favorable characteristics for the space include oligopolistic market shares, high return on invested capital, strong brands, low private label penetration, and strong cash generation that is able to support reasonable leverage. Looking at Heineken specifically, the company holds a number 1 or 2 position in more than 70 countries and generates more than half of its revenue from emerging markets. More than 40% of sales come from premium products, led by the world's best-selling premium beer, Heineken itself. Now, I wouldn't describe the overall beer industry as particularly fast-growing, but mid-single-digit top-line revenue is a reasonable expectation, particularly for Heineken, who should outgrow the industry on the back of exposure to faster-growing markets like Brazil and Vietnam. Heineken should also grow earnings faster than revenue, driven by the company's evergreen improvement plan, for which there is a lot of low-hanging fruit, like reducing the number of ERP systems in use from 45 to something more manageable. As for the valuation, the multiple is a low double digit of next year's earnings, give or take a turn. So let's call that a high single-digit free cash flow yield. Add to that the annual growth of mid-single digits, and it's not a stretch to see how one can earn a low double-digit rate of return in a base case without relying on aggressive assumptions or a multiple re-rating. The next question is asking us to talk about Alphabet, the top holding in the fund. We originally purchased Alphabet back in 2010, and at that time, we never would have thought that the business would grow to the size it has today. That growth has been driven not just by search, but by other segments of the business that have been phenomenal successes. That includes YouTube, the cloud business, Waymo, and several others. If you think about Alphabet as a whole, the company actually has more properties with 500 million users than any other company globally. This has allowed the business to generate tremendous amounts of data. It's built out infrastructure that is unrivaled on a global basis and has employees who we consider to be leading as it relates to virtually all aspects of artificial intelligence, the cloud, and search. Within that, Google continues to respond to roughly 8.5 billion searches per day in their core business, of which roughly 13% are new. That would equate to over 3 trillion searches per year, if my math's correct. Now, there have been concerns about competition encroaching on Google's search business, which continues to drive the majority of the company's earnings. However, since the introduction of ChatGPT, Google has continued to maintain roughly 90% plus market share in almost all of its core markets. During that period, we've continued to also see YouTube grow. We have Waymo that is now providing roughly 20% of the rides in early launch markets such as San Francisco, and earnings have continued to expand along with that of the core business and ancillary products. When we look forward in the age of AI, we see Google as being particularly well positioned for the reasons we mentioned earlier. The company has access to amongst the greatest trove of data in the world across its various properties, has incredible infrastructure, and very talented people. We think those are ingredients that set the company up very, very well for how the AI competitive aspect will evolve over the coming years. And we look forward to monitoring new product introductions as they are released over the next 12 to 24 months. And that wraps up the call. Order.